I'd like to call the Audit Committee meeting for April to order. First of all, do we have any public comments? Seeing none, we'll move on to the approval of the minutes. Can I get a motion to approve the minutes of January 30th? All in favor? Approved. Mike, why don't you go through the Audit Committee, what the plans are for next month? Because
Sure.
we've got an odd schedule.
We have 4 meetings this year, including this one. Just a note to everyone, the CFOs and controllers, regarding the June 5th meeting. It is early in the month, and the quarterly financial statements for the first quarter are due, so it is a tight time frame. And as far as the management letters with Deloitte, also, we need them as soon as we have them in end of May, so we get out to the Audit Committee. So it is a very tight time frame, and we do want to meet those deadlines. So if all involved could please do their best to achieve that. We also have the single audit report, the investment compliance report at the next meeting, and then we'll go over with Lamont any open audit recommendations that the agencies may have, and we've had very good success in this area in the past. And then after that, our next meeting would be then September 2013, followed by January 2014.
Yeah, these meetings have been set up appropriately to accept the quarterly financial statements as they come due. And it's a test. We'll see if how we make out with 4 meetings. Okay, next on the agenda is the 2012 financial statements. Called David up with his cast of characters. Going to start.
Talk about the financial statements,
Okay.
and then I'll go after him.
Thanks, Bob.
It's better than being in your face.
Okay, today we're going to go through the 2012 MTA Consolidated Financial Statements, which includes all of the MTA's agencies. The consolidated financial statements are prepared in conformity with GAAP, generally accepted accounting principles. And those principles for government are set by the Government Accounting Standards Boards, otherwise known as GASB, which are a little bit different than what's used in industry, which is called FASB. The consolidated statements include 5 parts. There's the management discussion analysis, otherwise known as MD&A. The consolidated financial statements, which include the consolidated statements of net position, the consolidated statements of revenues, expenses, and changes in net position, and the consolidated statements of cash flows. Now, there was a change this year in the title of the financial statements. They used to be called the consolidated statements of net assets. So under GASB 63, that has changed to net position. And I apologize, in the handout that was mailed to you, it still has net assets, so we're still getting used to the new terminology. The third section are the notes to the financial statements, which provide detailed disclosure for a better understanding of what's in the numbers. Then we have 2 required supplementary disclosures required by GASB. There's the progress on funding the pension plan liabilities and the progress on funding the post-employment benefit liabilities. Those liabilities are not included in our financial statement, so this is additional disclosure. And then 5th, we have additional supplementary information which is not required by GASB, but it is required by an agreement between the New York State Comptroller and the MTA, and that's a reconciliation between the audited financial statements and the MTA financial plan actuals that are reviewed at the Finance Committee. Okay, we'll start off by looking at our assets and deferred outflows. So we can see that our assets increased by $595 million in 2012, up to $63,094. Of course, the biggest category is our capital assets, which are 86% of all of our assets. They increased by $2 billion. Other assets decreased by $1.4 billion, and deferred outflows of resources, which are basically the fair market value of our swaps, they declined by $82 million for the year. Okay, looking at the detail of our fixed assets, our capital assets, we have land, construction in progress, buildings, bridges, tunnels, passenger cars, buses, infrastructure, other. We can see the makeup of the increases there. These numbers here are net of accumulated depreciation. And for this year, what's a little bit new is that since Hurricane Sandy, we had asset impairment. So these numbers are actually net of write-downs or losses on some of our fixed assets for Hurricane Sandy. So there are asset impairment losses netted in these numbers. I'll get to that later, but the total asset impairment losses were $537 million. Just some of these significant, that's a little bit hard to read, areas that contributed to the increase in capital assets. We have our mega projects, East Side Access, 2nd Avenue Subway, number 7 extension, station improvements for elevator replacements and American Disabilities Act, infrastructure work for deck replacements on the Bronx-Whitestone Bridge and the Throgs Neck Bridge, track rehab work, purchase of new buses for the Transit Authority, signal and communication projects for Long Island Railroad, and rehab of line structures and subway tunnels. Okay, moving to other assets and deferred inflows. Other assets decreased by $1,484 million. Most of that decrease, or the decreases, were in investments. And investments decreased primarily because we terminated leases in 2012, and for those, so you'll see a similar decrease in the liability side. For the leases that were terminated, we were holding investments that were basically collateral on those leases. So when the leases were terminated, those investments basically were given up in the lease termination. So that accounted for a $363 million decrease in our investments held under capital lease obligations. And then there was an additional decrease of $191 million in our investments, basically due to usage of operating and capital funds for agency operations. Accounts receivable declined by $909 million for the year, and that was largely due to a reduction in a receivable from the state of New York. So state of New York, we had state service contract bonds, and the state refunded a large portion of those bonds in 2012. Now, for those bonds, we had a receivable from the state, which basically offset the total amount of the liability. So when the liability went away, because the state refunded under the dormitory authority, so the debt went away, and then the receivable from the state went away. So when we get to the liabilities, you'll see a similar $1.6 billion reduction in our liabilities. That decrease was offset by an increase of $775 million in insurance receivables related to Hurricane Sandy. So we did accrue an insurance receivable related to Hurricane Sandy for our damaged assets. Other current and non-current assets increased by $31 million, and deferred outflows of resources decreased by $82 million. And on that, we did terminate 4 swaps in 2012, and that contributed to the decrease in the fair market value of those swaps. Okay, we'll move now to the liabilities. Our total liabilities, $47.4 billion, increased by $932 million for 2012. Going through the categories, long-term debt decreased by $111 million, and as I mentioned earlier, the biggest part of that decrease was the New York State Service Contract bonds, $1.6 billion. Basically, the state refunded those bonds, but they refunded them through the Dormitory Authority, so those liabilities, those debts were removed from our books. Other post-employment benefits increased by $1.5 billion, and that increase is basically the difference between our OPEB expense, $2.2 billion, and the amount that we actually fund. And what we fund on OPEB is we fund what we call as pay-as-you-go, $420 million. Pay-as-you-go is the medical, dental, vision premiums, claims paid for retirees. And then this year, for the first time, we contributed $250 million into an OPEB trust fund. So we do have a trust fund set up. We've started those contributions. We had planned to do more than $250 in 2012, but because of Hurricane Sandy, we held back. But we will be contributing, I think, $125 million every quarter for 2013. Next quarter. So that will bring those liabilities down, and hopefully with investment growth, it'll put some kind of a dent in those liabilities. Accounts payable, accrued expenses, and other liabilities decreased by 189 due to a decrease in liabilities for retirement and death benefits and accrued interest, and a net decrease in accounts payable and accrued expenses of $29 million. Estimated liabilities from injuries to persons, workers' comp, and then claims for non-employees increased by $91 million based on the latest actuarial calculations. And then other long-term liabilities decreased by $405 million. And again, this is due to a decrease in the capital lease obligations, which I mentioned earlier. So there's a corresponding decrease in our investments for that amount, and this amount for the decrease in the lease obligations. Okay, next we'll move to our revenue, expenses, and change in net assets. Operating revenues increased by 2%, or $128 million. Operating expenses before depreciation increased by $254 million, or 2%, and most of that was in employee benefits, retirement, health plan, and OPEB expenses. Depreciation increased by $130 million due to the increased asset base. And then we have a new category this year: asset impairment and related expenses. And here we're actually showing a gain. So what this is this is the impairment of our assets for Hurricane Sandy, which was $531 million. We also had $106 million of repair and cleanup cost. We had an additional $6 million of impairment for Long Island Railroad for their concrete ties. And of course, all that is netted against an insurance receivable of $775 million, resulting in a $132 million gain. The difference here, under GASB 42, impairment losses for a hurricane are shown as part of operating the operation. So it is included in the operating loss. Before GASB 42, it was shown below the line as an extraordinary item. We had an increase in non-operating revenues of $96 million, or 2%, and we had an increase of $551 million in restricted grants and appropriations for capital projects, or a 30% increase. So in total, our change in net assets decreased by $337 million, which is a 61% improvement over last year. Last year, our net assets declined by $860 million. This is just a summary of the changes in the revenues, which I pretty much talked about already. Okay, next we have our net position, formerly known as net assets. Other people refer to it as our net equity or our net fund balance, and that's broken down between capital assets and restricted net position for debt service, restricted for claims, and then our unrestricted net position of $7.7 billion. So our total net position decreased by $337 million for the year. Okay, next we'll look at our cash flow. Our cash flow was positive for the year. We had an increase in cash of $30 million. Looking at the various categories, net cash used by operating activities was $942 million greater than last year, and that's primarily because of three things. $250 million was contributed into our OPEB trust, and then we had increases of $291 million in pension and $219 million in health and welfare costs, contributed to that increased use of operating cash. Net cash provided by non-capital financing activities, those are things like subsidies, taxes, grants and appropriations, increased by $139 million. Our net cash used by capital and related financing, debt service, purchase of capital assets, that actually was lower than last year by $431 million. And then, of course, we have our net cash provided by investing activities of $570 million, $399 million better than last year, attributing to our net increase in cash of $30 million. Okay, our first additional supplementary required information is the progress on our pension funding for our single employer pension plans. So there are three of them: Long Island Railroad, MAPSTOA pension plan, and Metro North cash balance plan. The total actuarial value of plan assets is up by $59 million, or 3%. Next, we have the total actuarial accrued liability. That, however, is up by $331 million, or 9%, resulting in an increase in the unfunded liabilities from $1.7 billion to $2.1 billion for 2012. Looking at the funded ratio, on a combined basis, there's been a slight deterioration. It went from 53% to 50% in 2012, and a lot of that really has to do with the investment performance for 2011, because this is measured as of January 1st, 2012. So hopefully, with better investment performance, this will improve next year. Okay, the next required supplementary information is our funding on our post-employment benefits, which is OPEB. Now, this is pretty much the same schedule as last year, because the actuarial evaluation is done every 2 years. There's really no change here, but what's not shown here is the fact that we contributed $250 million into a trust fund. So next year we will see the total amount with the investment returns in the actuarial value of plan assets. So no change in this. That's a $17.7 billion OPEB liability that is not really reflected in our financial statements. Okay, and finally we have the reconciliation of our GAAP audited financials to our financial plan. Total operating revenues were pretty much the same, difference of $1 million. Our labor expenses were a little bit lower by $1 million, and then our non-labor expenses were lower by $141 million. And the reason for that is basically on our financial statements we have a line called asset impairment and related expenses. So we reclassed expenses from non-labor expenses to that line item just to show the effect of Hurricane Sandy, so to make the numbers more comparable. So the real difference is if you look at the total net operating deficit of 274, And that deficit really is comprised of the asset impairment from Hurricane Sandy, which was $531 million, offset by a insurance receivable of $775 million. So those numbers are not included in the financial plan, and that attributes for most of our difference right there. So pretty much for this year, a good reconciliation. That's pretty much it. Does anybody have any questions on this?
I guess my first question is on the asset impairment due to Sandy. You know, I guess I was surprised to see that we're going to have a profit based upon the numbers that we come up with, and
Well, that's because the insurance is replacement cost insurance, and a lot of our assets are either fully depreciated or, have substantial depreciation on them. So, and then the ones that are not fully depreciated, they may have been built 10, 20, 30 years ago. So, our insurance is replacement insurance.
And Jim, I'd also add to that, that's pretty common. Actually, when you've seen that in the past, if you look at what happened with the Port Authority after 9/11, they showed a huge gain, and that was because the asset was, virtually depreciated, and the insurance proceeds, covered, at least there just some of the costs, but there was still a gain because there was virtually no book value.
But I guess I would just like to point out, this is where accounting and economic reality differ, because we know that our insurance is only going to cover a portion of our losses. We're hoping that FTA and FEMA will cover the vast majority of the remaining loss, but they're not going to cover 100%. So whatever we come out of pocket, our local share, is truly an economic loss for us. So again, it's just what we're required to do by accounting standards versus what we know eventually, when it's all settled up, will be the reality. So.
Okay, any questions? The other thing I might mention is in the MD&A analysis. I'd like to see some consistency between the agencies on how they present that.
Right.
Okay, since I'm involved with Metro North, I looked at Metro North in Long Island, and I look at the expenses listed in Long Island so that people can understand what's going on. And I don't see that in Metro North. I just think there should be some comparability.
The work continues, and there's been a lot of progress made, and now, actually there's been a project that was led by Pat. It's undertaken to kind of put the charts of accounts together. So you will, over probably next year, see very little differences. And we've really worked kind of hard to get everybody, using the same terminology, same type of reporting formats, and that's still in work, but it's getting there.
The other thing I noticed, which will, I think, when outside people start looking at this thing, we've gone under the premise we haven't had any wage increases this year, but we look at bus and transit, and we have some increase from one year to the next, probably timing and such, but I think we should be prepared to answer them, because that will certainly be a question.
Right.
And how did we make out with PeopleSoft? Did it work?
The consolidation model?
Yeah.
Well, we're ready to go for the first quarter. So in anticipation of the the early close and the early June audit committee meeting, we have we have the consolidation automated, and pretty much all the controllers are on board to go with the automated process. So it should speed it up quite a bit, and it should make things more consistent in the reporting. So we're ready to go for March, and then we're actually going to try to start churning out monthly balance sheets, and then I think over the next 12 months, we should be ironing out any differences or things that don't look right. So So we're getting there. It's
So David, how long did this take?
A while. I've been around a long time, and I've been working on it since I've been here. So a while. But it's getting there. I really am pleased with the progress. I really am. And you know, I'd tell you if I weren't. But I am pleased with how it's going.
Okay, any questions? Okay, David, you're on.
My maturity's showing. Can I get the lights? So,
Yes, I'm gonna put the lights. When? Do we need the projector? Roman, do you need the projector? When?
thank you.
He's gonna do it.
I know you did.
How he's doing it?
You have in front of you a letter that we issued today. I want to talk a little bit about this. There's a change in the letter that you're seeing from the past. Now, it's not really material, but there's a lot of change in format. The reason I mention it, there was a project that was undertaken by the Auditing Standards Board a few years back, and it was basically looking at the trying to reconcile some number of differences in accounting standards among the various bodies. It also looked at the manner in which our report has been presented in the past, and it made some changes in the format. But and there's a couple of other changes in the disclosures that are made as well. But this letter basically mirrors kind of the changes in the report. As your auditor, we met with you back earlier to discuss the scope of the audit, and we basically laid out the scope of our engagement at that time, and it's in our engagement letter that was dated July 18th of 2012. Our audit was substantially in accordance with that scope that was described to you. However, we did do a lot of work around the storm and the accounting for the storm that we probably hadn't discussed with you. We've looked at what management's done relative to their estimates with that. We spent a good bit of time, a lot of time, probably more than anybody wanted, but we spent a lot of time with management and the engineers looking at the processes, and we also toured facilities. We went down to the South Ferry and went through the bowels of the South Ferry and kind of walked out. And our question was, what's good? Not what's bad, what's good. So we did a lot of due diligence around that. As you know, an audit involves looking a process of and here's the material change that occurred in the letter. We've talked to you about a risk assessment for years and how we go about assessing risk. And as your auditors, we're required to assess risk of material misstatement of the financial statement, both in terms of fraud and just error. Well, now that's disclosed in your report. So once we've done a risk assessment, then we go about the process of considering the internal controls that are relevant to those risks and making judgments about the auditing procedures we will use to address those risks in financial reporting. I do want to point out that while we address those risks and while we address the controls, we don't design our audit to examine internal controls in a manner that would allow us to report on the effectiveness of those controls. To the extent that in the process of our audit we encounter issues that would indicate that there is ineffectiveness or a material weakness or significant deficiency, we would disclose that to you. And I'm happy to report there are none of those to report. On the second page of the letter, in the past, we've also basically, as your auditors, we're required to evaluate the accounting estimates and judgments that appear in the financial statements for the purposes of determining if those accounting principles are in accordance with generally accepted accounting principles, and they're consistently used, and that they are appropriate for use in an organization such as yours. We have reviewed those estimates and have concluded judgments and estimates have concluded that they're both in accordance with generally accepted accounting principles and that they are appropriate for use for an organization. There were a few changes to those during the year. As you can imagine, there were some changes related to Sandy and evaluating both impairment of assets and the potential for collection from, in this circumstance, it's just your third-party insurers. We've looked at those judgments and estimates, spent a lot of time looking at those, and we conclude that the amounts that are presented in the financial statements are in accordance with the accounting principles. There was a change in the method of hedge accounting during the year. You had some of the hedges failed the test that you had previously set up. The accounting standards basically said in that occurrence you can look at other tests. The authority did that. They changed from basically looking at changes in interest rates to changes in total cash flows, which really is what the purpose of those interest rate swaps were intended to do anyway. And they basically did an analysis on the basis of changes in total cash flows and determined that the hedging relationship was still appropriate. Actually, we concur with that change and think that it is probably a better change. There are also, we also looked at the depreciable lives of capital assets for one reason. This year, more in particular, we always look at it, but with the storm, we have past experiences told us that the assets that may have been designed to last 40 years may now only last 20 years. So we looked to see if there were any estimates that could potentially impact that. And we know that management's continuously, this process will take a long time. Things that aren't apparent today will be apparent tomorrow and maybe, sometime way in the future. So those issues will certainly, will continue.
Does that also mean that when the MTA rebuilds a facility better than it was before to withstand a future storm, that will show in next year's audit as an appreciated asset? Or?
No. What happens is your assets were written off, or we didn't have any changes, by the way, in the depreciation lives. Now, we're just mentioning it because there's a possibility that will occur, and we all recognize that will occur. But what happens when you rebuild the asset, it's put on the books at its full value, what Bob was actually talking about. The accounting has very little to do with the replacement cost. So you have an asset that was on the books at zero, and by the way, the net book value of particularly a lot of the switches and signals have been around forever. They were fully depreciated, so the book value was zero. The cost to replace that, and probably the original cost was, just using an example, $1 million, and now it costs you $8 million to replace that. So what will happen in that circumstance, it will be put on the books at $8 million, and then it will be the $8 million will be depreciated over, its estimated useful lives. Any other questions?
Will the estimated useful life figure
like a new asset?
Yeah,
right.
but,
You look at
if it's built better than originally to withstand, for instance, a future storm, would it have a longer useful life?
What will happen is the engineers will say this asset. I see where you're. I'm missing your point, but and I'll get to it. The engineers are going to say basically this is the estimated life of this based on our design, and it generally gets depreciated over that. If you have a hardening, there's going to be a number of hardening projects. So if you have a hardening project and you determine based upon that project that the asset that was already there and maybe didn't have a lot of damage to it has a longer life, yes, you can have a change. And in that circumstance, extend the useful life. If you can demonstrate that, yeah, you could do that. There are no uncorrected misstatements in the financial statements. We had a couple of what we call audit adjustments. One related to the reclassification. It was at the TBTA, was a reclassification of a negative balance in a cash account, which is a liability, so that's what we did, reclassified it as a liability. And then there was a minor difference in a confirmation that we'd sent out, and there was an adjustment made to that. The significant accounting policies of the MTA are described in Note 2 to the financial statements. Again, we're required to look at the accounting policies for the purposes of determining that they are in accordance with the accounting principles and that their use is appropriate for an organization such as the MTA. We've looked at those and have determined that their use is appropriate. We're also required to disclose to you any changes that occur in accounting principles. There are a number of GASB standards that were applied this year. However, the only one that really had any real change, and it wasn't a lot, was GASB 63, which dealt with the reporting of deferred outflows of resources and deferred inflows. For the market valuation adjustment that appears on your financial statements for the swap instruments, it now is included in a separate section of the balance sheet. That is the only change. No new information other than within the geography. It's disclosed in a letter, and I'm not going to go through those with you. There were a number of accounting standards that became effective during the year, but they really didn't have any material impact on the financial statements. As your auditors, we're also required to review other information where the financial statements are issued. Your financial statements are issued in offering documents. And as a result of that, we do read all of your official statements. We compare the amounts in the official statements and the words in the official statements to make sure that it is consistent with the information that is presented in the financial statements. We also perform procedures to determine if there's any event that would cause us to conclude that maybe the financial statements should be updated during the year. And we go through a pretty extensive process with each of those. We had no disagreements with management. There were no consultations with other accountants that has been reported to us, and
David,
as well.
Can I ask a question on the offering statements? Do you typically prepare a certificate that says what you've done in connection with these offering statements, or do you just allow us to include it?
We give you what's referred to as a
right?
consent letter, right?
So the other stuff you're talking about, you do away from the transaction, you talk to management about?
Well, in order for us to issue that consent letter, we have to undertake these processes.
Okay, you guys always have processes. Good.
Okay.
Got
I mean,
it.
it's really a part of that.
Yep, thanks.
There weren't any other issues that we discussed with management. I mean, we did have lots of discussion around the storm and the impact of the storm, and again, there will be a continuous process. What you see today, and the reason I mention that, will be different a year from now, and maybe even different, that may be different a year from then, because of the likelihood to discover new types of issues that occur along the process. Because issues known today or unknown today will be known sometime in the future, and you will make adjustments accordingly. We did have included in your package, and by the way, I apologize for the foot of paper that you get, but that's just the fact of that you get all the financial statements that you get. But included in your package are all the drafts of the management letters that management will issue to us regarding their assertions in the financial statements. And they're there for your review. To the extent that you have any questions about any of those things in there, you can feel free to call me, and I'll be glad to discuss those with you. We did have an emphasis of a matter paragraph that basically said you adopted GASB 63 during the year, but it really has no real material impact. All of the disclosures that I have made to you applies equally to the rest of what we refer to as the related entities of the MTA, which would be Metro North, Long Island Railroad, Sertoa, FEMTAC, TBTA, who did I miss? And Transit and Long Island Railroad. There is no emphasis of a matter paragraph in the other entities report because the impact of GASB 62 is a consolidated financial statement issue only. We are required to disclose to you that there are other information presented in the financial statements. Now, this is a change. Pat's already mentioned to you there's various parts of the report. You have a couple of things that are called required supplementary information. As your external auditors, we're required to review that information but not audit it. But we are required to review it to make sure that it's consistent with the requirements of the accounting standards and that it is consistent with the information included in the financial report, and we have done that. There's also other information included in the financial statements that's not required by either GAAP or some other higher body, such as your budgetary financial statements. Now, one might conclude that's a higher body, but there's no real standards around it. However, we are required to review that information to make sure that it's consistent with the financial statements and the other information that's appeared in there. We have done that. The same thing applies for the other related entities. In the last year, we did report a material weakness to you regarding the inability of Sertoa to issue financial statements on a timely basis. We're glad to report that that has been corrected. I'll answer any questions that you may have.
Any questions for David? Okay, I think we need a motion to accept the audits as presented. Second, all in favor? Any opposed? Carried. Okay, Lamont, you're on.
Okay. Good morning. On page 11 of your committee book, you'll see there's a memo from me regarding the status of the 2012 financial disclosure statement filings. In 2012, we had 5,673 employees who had to file a financial disclosure statement with the Joint Commission on Public Ethics. At the time I prepared this memo, there were only 11 employees who had not filed. Of that 11, now only 2 are still delinquent at this point. As you can see from my memo, we have been pushing those numbers down in terms of ensuring that we get compliance by our employees with this requirement. On the next page is a memo that I sent out. I know many of you may have already received that wonderful reminder from me that it's that time of year again. Your financial disclosure statements are due May 15th, and we are actively working with our employees to ensure that we get that in and get it in on time.
So what you're talking about is the disclosure for 2011.
Right. Each year, this year you're filing 2013, but it's for your financial information for 2012. So it's always 1 year behind. Yes?
There's also a change this year.
There is a change in the financial disclosure statement this year. It really impacts those individuals who have approved outside employment, especially the individuals who have clients. And there is a requirement that those clients be disclosed in the financial disclosure statement. We have reached out to employees that may have that issue, and it's something that we really need to talk about on an individual basis. It's not going to impact a large majority. It's not going to impact very many of our employees, but it is something that is concerning to those employees who do. The disclosure of clients is somewhat concerning. But if anyone has that issue, they feel free to give me a call and we can discuss it. And there are more categories, too. In the past, there were only 6 financial categories. They're now up to, I think, 31 or 32 to make sure that they capture any income over, I think, $9.5 million that our employees may have.
And they've eliminated the fill-in. If you do it on a computer, you've got to start from scratch.
Yeah, I take no responsibility for that whatsoever, but yeah, it's a new form, and unfortunately that's what happens. But no. From my understanding from JCOB, they will still accept if you have to file with another state entity or city, they will accept that in lieu of.
Okay. Any other questions or comments? Okay, I'd like a motion to go into executive session to discuss aging agency. Oh, I'm sorry.
The ethics
I thought you were
presentation.
done.
No, you got to ethics. It's in the
Sorry.
page 15.
On page 15, each year I present an overview of the MTA's Ethics and Compliance Program. Again, we have several strategic alliances with governance, internal controls, regulatory disclosure, investigations. We are providing either oversight, direct oversight, or we coordinate in all those areas. Last year in 2012, we handled over 470 ethics or compliance issues. These are ones that required what I like to call some real work. These weren't the questions that employees may have in passing that we can answer very quickly. These were things that involved a lot of detailed discussion on our part to make some determinations about what would and would not be appropriate. We still maintain an ethics helpline, but many of the inquiries we receive are coming in via email or directly via the telephone. We continue to handle issues involving attendance at prohibited source events, outside activity, gift issues, financial disclosure, and acceptance of honoraria and travel expenses. In 2012, we have continued our ethics training program, again covering many of the areas I just discussed. We are putting additional emphasis again on social media and confidential information, the duty to disclose, outside activity, and whistleblower protection. We are emphasizing those in our training in 2012, and again we're still doing that this year. In 2012, we had 38 sessions. As of right now, we have 31 sessions scheduled for this year. And as the year progresses, we'll see how we do in terms of those sessions. Yes, I do. I have one other person who assists me with that as well. But again, 2013 is going to be a bit of a transition year. There are some requirements of the Public Integrity Reform Act regarding training, and we're working with JCOB now to figure out what the impact of PIRA will be on our 2013 training schedule. It could be substantial, but we just don't know at this point. The next page you will see we had initially projected to this committee that in 2012 we would have trained 2,486 employees. As you can see, we exceeded that. We trained 2,795 employees. And I can tell you every single one of them was very happy to spend 3 hours discussing ethics with me. Oh, everyone laughed at that. Okay. Communications is still an important part of what we do. We send out memos to our employees. We will be doing another distribution of the Code of Ethics next year. We distribute it to everyone, so that would be around 67,000 copies that we will be sending out. We have been getting some indications from Albany that they would like to see a more frequent distribution, possibly annually, but we haven't determined whether that's going to be a requirement or just a suggestion at this point. In terms of no, I actually don't. In terms of manpower or in terms of the actual print cost, because the manpower is going to be much more substantial than the print cost. Yeah. Yeah, I can provide that. We don't have that number. I'm hoping we won't have to do it annually, but in this technological age, I'm not exactly sure why it's necessary to print books and mail them, but okay. Okay. On the next page, again, we send out memos. I'm sure all of you have seen those. We continue to put up signage promoting the ethics helpline to get people to call us before they engage in conduct that might be problematic. We did begin a few new initiatives this year. As I know everyone knows, we have MTA Today now, which is on our computers. One day each month has now been dedicated to ethics. We provide ethics guidance, and we also are using entertaining videos to try to engage employees' interest. When we first began this project, we have the memos, and I honestly believe that putting out a memo every month about ethics would not be exciting, would not get people to read it. I really believe there comes a point where you get memo fatigue, and you read the first line, oh yeah, I've seen this before, and move on. So we're using videos that are put together by Second City Communications. They're comedic in nature. So we couple that with a serious message so that we at least get a couple of minutes of engagement every month in terms of ethics. So we started that in 2012, and we've gotten some very good feedback on that as well. We're also distributing to senior management copies of Ethicos. We're doing that electronically, that in a hard copy, as well as Tone at the Top. Those are being distributed to senior management to continue the engagement about ethics and compliance issues. And again, we continue to coordinate with various departments, including the MTA Inspector General, Audit Services, the Joint Commission on Public Ethics, and others. So if there are any questions about our ethics or compliance program, I'd be more than happy to answer those. I will be happy to add you to the mailing list. The email comes from corporate compliance. As I told everyone when we first started, please don't delete it or block it. But that's where it's coming from, corporate compliance. It's not spam. We'll send it to you. No, it's in English. But there's some very interesting articles about what other entities and corporations are doing in the ethics area. So the idea was to engage management in discussions about what we do and maybe what we can do better.
What are prohibited sources?
Prohibited sources defined in our Code of Ethics, it's a very broad definition. It's basically anyone that we are doing business with, anyone who's indicated an interest in doing business with us, any individual firm that we've done business with within the last 5 years. It's any company that we are leasing space from or leasing space to. It is any lobbying organization. It's a very encompassing group, but that's what a prohibited source is.
And does it prohibit attendance at these functions, or does it
just
require disclosure?
It actually requires, where our code works, it actually requires approval. So, for example, if Bob or Mike was interested in attending a prohibited source event, they would send me a request to attend. We would review it to determine whether there were any issues with their attendance, both from a purely technical perspective, is it a prohibited source event, does it meet the qualifications to attend, and also just from a general ethical perspective, whether there is something about this organization, this group, or the event that we should be concerned about. Periodically what we will tell them is, yes, you can go, but here are some things that you should be concerned about based upon perhaps the attendance or who might be at the event. But we vet those thoroughly to make sure that there are no issues and hopefully no appearance issues as well.
Okay, any other questions? Okay. Okay, now I need a motion to go into executive session.
Second.
All in favor? Okay, we're in executive session, please.